Brad Williams, Frugal Finance. Let's talk about converting a fixed rate asset into a floating rate asset. As we noted previously, the comparative advantage fixed for fixed swap was predicated on a market imperfection, conflicting credit risk assessments of the two counterparties in two countries. We now focus on two examples of using swaps that do not rely on the presence of market imperfection. These examples are more closely related to current market conditions and the actual business practice of firms. As an example of a prime candidate for an interest rate swap, consider a typical bank. The bank accepts deposits, lends those funds for long-term mortgages because most deposits are short-term. Deposit rates must adjust to changing interest rate conditions. Most mortgagors wish to borrow at a fixed rate for a long term. As a result, the bank can be left with floating rate liabilities in fixed rate assets. This means that the bank is vulnerable to rising rates. If rates rise, the bank will be forced to increase the rate it pays on deposits, but it cannot increase the interest rate it charges on the mortgages that have already been issued. Now, keep in mind, this paragraph is dated. With securitization, this can be sold off, split up, marketed in a zillion different ways to reduce the risk, separate from swaps. Then if you're a private equity firm and you're buying this stuff, then you might do some swaps. But just keep in mind that a lot of this information is a little bit dated, and there are a lot of products out there that you can intertwine to reduce your risk, improve your efficiency, control those variables. You have this duration problem, you have the gap finance variation, in other words, short-term, long-term. You have a lot of different variables. Now, swaps clearly play an important role here, but you can combine a lot of different vehicles, and that's your job, is to find out what vehicles work best for whatever environment you're in. To escape this interest rate risk, the bank might use the swap markets to transform its fixed rate assets into floating rate assets, or transform its floating rate liabilities into fixed rate liabilities. Let's assume that the bank wishes to transform a fixed rate mortgage into an asset that pays a floating rate of interest. In terms of our plain vanilla interest rate swap example, the bank is like party A. In exchange for the fixed rate mortgage that it holds, it wants to pay a fixed rate of interest and receive a floating rate of interest. And why would you do that? Comment. Keep in mind, what happens if interest rates rise? What happens if interest rates drop? What if the normal refinance rate is 3.5 years and all of a sudden it skyrockets and you have this immediate surge in refinancing? These are some of the things you have to think about. Thus, the bank wants to be a pay-fixed counterparty in a swap. Engaging in a swap, as Party A did, will help the bank to resolve its interest rate risk. To make the discussion more concrete, we extend our example of the plain vanilla interest rate swap. We assume that the bank has just loaned $1 million for 5 years at 9% with annual payments. And we assume that the savings and loan pays a deposit rate that equals SOFR minus 1%. With these rates, the bank will lose if SOFR exceeds 10%. It is the danger that prompts the bank to consider an interest rate swap. Figure 20.7 shows our original plain vanilla interest rate swap with the additional information about the bank that we've just elaborated. In the figure, Party A is the bank, and it receives payment at a fixed rate of 9% on the mortgage. After it enters the swap, the bank also pays a fixed rate of 9% on a notional principal of $1 million. In effect, it receives mortgage payments and passes them to Party B under the swap agreement. Under the swap agreement, Party A receives a floating rate of SOFR flat. No one knows what that is in the future. You're going to have your initial rate, then you have to look forward to see what the market predicts in terms of futures, but that's variable. That changes on a second by second basis when the market's open. So that's an uncertainty. From this cash inflow, the bank pays its depositors SOFR minus 1%. This leaves a periodic inflow to the bank of 1%, which is the spread that it makes on the loan. It knows it's predictable. In our example, and you can look at this, ignore LIBOR, just change that with SOFR. Haven't updated this. In our example, the bank now benefits from a fixed rate inflow of 1%, effectively shielding itself from interest rate risk. Regardless of fluctuation in interest rates, the bank is set to receive a steady net cash inflow of 1% on $1 million. Now, if that was $1 billion, you could see the cash flows. This example underscores the bank's strong incentive to participate in the swap market. Given the inherent risk exposure to rising interest rates within the banking industry, engaging in an interest rate swap allows the bank to secure a fixed rate position. And clearly, they can look at their portfolio and they can diversify it. In other words, they don't have to put all their money into a swap. Worth noting that the bank could have reached a similar deal through alternative means if not for regulatory constraints and willingness to restrict its business operation. For example, it could have mitigated interest rate risk by paying off all depositors and issuing a fixed rate bond to finance its mortgage lending. However, such a strategy isn't feasible for a bank, as it would essentially cease to function as a depository institution altogether. In contrast, the swap market offers an attractive solution, allowing the bank to manage its interest rate risk without fundamentally changing its business operation. Here, the driving force is business efficiency rather than seeking arbitrage profits. Brad Williams, Frugal Finance. Thanks for watching.